Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Zhong, and welcome to Through the Noise podcast. In the past week, US equity notches new all time highs, while 10-year government bond yields rose and broke above the key 4% level. The divergence in US stock and bond prices refocused the attention back on stock bond correlation. To discuss this and more, I'm happy to be joined by Audrey Goh, our head of asset allocation here at the Seattle office. Hi, Audrey. Let's dive right into the first question. Does the current equity rally still have legs? And how do the bond yields fit within that?
Hi, Jong. So we're going to start the U.S. earnings reporting season this week with major banks slated to start reporting as well. So if you look at the overall earnings expectation, they have in fact been lowered into the quarter, hence making it easier for corporates to deliver a beat against subdued expectation. And this may potentially extend the rally and also ahead of positive seasonality that we tend to see towards the end of the year as well. But having said that, in the short term, sharp spikes to bond yield may represent a risk because over the course of the last week and a half, we have seen bond yield spiking higher by about 15 basis point when it comes to the 10-year US Treasury bond. And historically, sharp spikes of between, say, 20 to 30 basis point over a short period, say about 3 months, could potentially lead to a short-term pullback in risk assets as correlation between bonds and equities turn positive. And let us also not forget that we are just 3 weeks away from the US election. And equity volatility is also likely to rise ahead of the US election in November. So, against this backdrop, we would advocate investors to consider averaging into developed market investment grade bonds, where it now look relatively more attractive after the recent surge in bond yields, where the US 10-year bond yield broke above 4%.
Okay, Audrey, so you're saying averaging into DMIG bonds given the attractiveness following the latest surge in yields?
Yes. We believe that the risk reward balance now look more attractive than a few weeks ago. Technically, if we look at just technicals, we can see that developed market investment grade bonds are now looking a bit oversold. And the next key resistance for investors to watch out for is really the 4.15 to 4.17 mark when it comes to the 10-year Treasury bond yield. Investor expectations now are also more benign, with markets expecting just two more rate cuts of 25 basis point each for the rest of the year. And that is largely in line with the Fed's projection. So we see this as an opportunity for investors to consider extending their duration in their bond portfolio and also to raise exposure to developed market investment grade bonds, particularly in the sovereign space. And certainly with the rise in yields that we have seen so far, even developed market corporate IG bonds also look quite attractive given the absolute higher yield on offer. That being said, credit spread, which is a measure of their valuation as well, remains near cycle low, so they are nowhere near cheap. But to us, it does reflect a certain level of confidence that investors have in the health of the US economy.
Interesting point there. Let's discuss a little bit about China, specifically China equities. They saw wild swings in the past week. What is the outlook there?
So over the weekend, we have seen China delivering further details about fiscal support for the economy, with spending expected to accelerate at high single digit versus being negative for the first 8 months of the year. So with fiscal impulse likely to turn positive for the rest of the year, and with the potential for this to spill over into the first half of 2025, we do believe that it should help to reduce downside risk on China economic growth. So net-net, we see China remaining as a core neutral holding within deficit portfolios and would prefer to focus on laggards plays, particularly for stocks in the consumer-related sectors, such as in consumer discretionary, as well as in communications. Our base case is for the HSI index to trade between 20,000 to 22,500. And then in the bear case scenario, the trading range should be around 18,000 to 20,000 thereabouts in the event that further fiscal measures and even execution underwhelms market expectations.
Well, lastly, I want to touch on the other major EM country, India. RBI just had its latest monetary policy meetings. What are the key takeaways there?
So on India, the Reserve Bank of India have basically shifted their policy stance to a neutral in their latest meeting, while keeping policy rates unchanged given a rather balanced outlook on growth and inflation. We believe that this move will afford the RBI a greater flexibility to adjust monetary policy as needed, giving the committee room to either raise or lower rates depending on how the inflation picture outlook evolve for the rest of this year. But overall, it is a dovish shift, and this dovish shift is positive for Indian assets in our view. And historically, the start of easing cycle should allow bond yields to fall, therefore supporting our preference for India offshore bonds. And FTSE recent inclusion of India into its emerging market government bond index is also supportive for inflows into this asset class. And then from a real rates perspective, a decline in real rates should benefit and support economic growth as well as earnings momentum, therefore supporting flows into Indian equities, which have retreated slightly in recent months.
In summary, the equity rally could have legs if US corporate earnings once again beat subdued expectations. However, we note that history suggests a sharp spike in bond yields in a short period typically leads to a short term pullback in risk assets. Also, we are mindful of equity volatility, which is likely to rise heading into the US election in November. Against this backdrop, our core recommendation would be to average into bonds, which look relatively attractive after the latest surge in yields. Thank you, Audrey, for the engaging discussion. Thank you to our listeners for listening from start to end. With that, we'll close off this week Through the Noise podcast. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.